Hey there, Rick. How you doing?
Hi, Joe. How are you doing?
I'm
Good to see
doing
you.
great. I'm doing great. Thank you so much for joining us today.
Pleasure.
I haven't done one of these in a little while. When Shelter in Place first started, I was planning on doing this like weekly, and then I just got unfortunately too busy selling homes. But now I'm glad that you agreed to be on this with me because you have a really good, interesting perspective, and you have a really good resume here. So let me just introduce you for my audience here. I'm with Rick Raybin, and Rick, you live in San Mateo. And how long have you been in San Mateo?
Well, the first time I moved to San Mateo was in 1979,
Uh-huh.
actually, and lived there, lived in and around San Mateo for around 15 years, and been in the Bay Area. Actually, I first moved to the Bay Area in 1975, so
Hmm.
I've been here the whole time.
Great. So, so you're a longtime San Mateo resident, and that's great. So let me give a little intro about you here. So you bring over 40 years of experience in finance. Your first job, where you started your career, was as a CPA with Coopers and Lybrand. And then from 79 to 1990, you were the chief financial officer for Rosenberg Real Estate Equity Funds, better known as RREEF. And this firm was a pioneer investing for the largest US pension funds in income producing real estate. And while there, you helped found and served as the first president of the National Council of Real Estate Investment Fiduciaries. And they currently publish a series of indexes on the investment performance of real estate. I'm going to pause because there's so much more I can say about you, but can you tell me a little bit about that?
Well, sure. So back in the early 80s, we were trying to get more money from the big pension funds, from the big institutional investors to go into real estate. Back then, they were maybe allocating 2% of their overall investment portfolio. So let me go back historically. In 1974, Congress passed ERISA, which up until then, the pension funds were pretty much limited to what they could invest in, basically bonds,
Mm-hmm.
just to be real conservative. But the companies, major corporations said to be more conservative or competitive, we need to be able to invest in more things with higher returns. And so ERISA was enacted, which gave them more latitude what they could invest in. And real estate was one of the things they could invest in. So
Mm-hmm.
we were then kind of tasked with helping the pension funds come up with a good argument, or helping the consultants, the pension funds, come up with a good argument on how they could invest even more into real estate than the little bit they had been doing. And
Mm-hmm.
so Frank Russell put together a group of us. And I remember meeting over in Emeryville. The Holiday Inn was over in Emeryville, and we sat around the table and came together, and all the accounting officers for all the major investment firms agreed to share our information, pull our data together. And Frank Russell Company, which was the major consulting firm at the time, would keep all the data confidential, but share it and pool it so they could put together this index. And back then it was called the Frank Russell NCREIF index. And we began an index. And so we would start tracking it. As it turned out, I became the first president of the industry group that we started from that effort. And we went public with that information, and it worked, but it didn't work because we were quickly disabused of the notion, because we were only valuing real estate. Our real estate holdings are only valued annually by appraisal. And the big knock on that, compared to stocks and bonds, which are valued daily, or even more often based on how you're tracking the stock market. And so that was a different type of valuation. And so there was a criticism of that we weren't mark to market daily. And
Mm-hmm.
so when I went to present I actually presented the initial announcement of our index, and that was the criticism we received right out of the box.
Mm-hmm.
And so although it helped some, and it, in a sense has continued to work to help establish real estate as an investment asset class, that's what we experienced.
Okay. Okay, great. So after you left, so it looks like you left in 1990, RREEF. You've advised families on a variety of financial issues through your firm, Lifetime Capital Group, where you actually make it a little bit easier for your clients, live the life you want, they want. And in 2017, you did write the book, Investing 3.0. So which we see right there, right behind you, right below the Lifetime Capital.
Right on the wall behind me, you can see the
go.
Investing 3.0.
And I'll actually have a link in the descriptions to where this video will be posted to the book too, so people can just quickly get it. Should I post the Amazon link or which one?
Yeah, that's the Amazon link is where they can go and
Perfect.
get that.
That's the easiest one. Excellent. So that's what you've been doing since leaving. And so that's a little bit of a different position in a sense.
Right. So, well, part of what my passion is about helping people.
Mm-hmm.
And what I find is, so when I was at RREEF, as a chief financial officer, a lot of my role was covering all sorts of aspects of running the firm. So I was not really a real estate guy. I was more of running the business, the operation. So I coordinated with the bankers, our attorneys, the CPAs, all the different aspects of it, coordinating professionals. Mm-hmm. And so very much what I do today is bringing all the professionals together, all the wide range of financial issues to help people coordinate all that, making sure someone is being well taken care of. And also while I was there, I found that, in fact, while I was growing up, I would see different people come to our home and try to sell my parents on investment opportunities. And that's somewhat what led me to even become a chief financial officer, was the idea that I thought you had to become an insider to really do well financially. And so that's what I set out to do. And I did become that. And I got to see deals as they were happening. And I quickly learned that, those weren't such good deals that were being presented to my dad, which is his expression of, it's such a good deal, why are they bringing it to me?
Yeah.
And in fact, that's
I
part of
love
our
that
talk
expression.
today I'll expect to get into. A lot of these deals guys are pitching that they'll be managing for you. Be careful about that.
Yeah.
And that's where I was seeing that. And so what I do today is trying to protect people from those kind of offerings and how you can do that. And so that's what my practice is really built on, is trying to make sure all the aspects of what goes on are people are well served and they're being well supported.
Yes. Yeah, that's great. And I definitely agree with that philosophy. I have that same feeling, because I think every time that anybody has come to sell me something, for the most, I wouldn't say it's a ripoff necessarily, but oftentimes it is not the best possible product or service out there.
Right.
There is a small percentage, I would say, of the time where they are bringing something that's good, and it is. But that's why you always have to do your due diligence and look at the numbers. And I think it's pretty clear what is good and what isn't, and you'll get into that a little bit more. So last December, you spoke at the Commonwealth Club in San Francisco, interviewing Mac McCown. McCown. Okay, good. See, I'm glad I phrased that as a question. McCown, good. So who led the team that created the index fund? That's right, you were talking about this. And you're following that up by working with a member of Mac's team on a book that tells the behind the scenes story of the development of the first index fund. Yeah, that's very interesting. Can we go into that a little bit?
It's a fascinating experience. There's a real story here. This was, I would say this is like you hear about fintech today, financial technology and all these kinds. This may be the first fintech before there was even Silicon Valley. These guys came together in the early 60s and actually were a revolutionary group that basically took on Wall Street. And they brought computers and investing together, and they brought the best minds in the world together to really try to conquer the understanding about investment finance. And they kind of had a blank slate. They were financed by Wells Fargo. They were actually a management sciences group within Wells Fargo, and they were there to kind of reinvent investments. And it was a fascinating story about who they hired, how they hired them in, and how they went after one time, step by step, and trial and error, trying to figure it out. And finally, they got a hold of some consultants, some academics out of the University of Chicago and MIT. And ultimately, they hit on a solution that worked. And it was really a bunch of trial and error, but it really revolutionized it. And that's where index funds came out of. And actually, their first iteration wasn't even around indexing. And it's just a fascinating story. And they just kind of fell into it. But they proved by doing it differently than the way Wall Street did it, that how you can be successful. And they've really turned the table on Wall Street, which is really to the benefit of all of us. And to me, the big takeaways from this are that they're very much about the integrity of the information, not trying to scam us, sell us something that was basically a marketing product, but really based on what the data provided. So it's very much what they call evidence-based. And they're committed to being the integrity of their process. It's very scientific, like following scientific research. Those are the things of the hallmark of what they've done.
So pardon me, I'm going to jump into something real quick. So pardon me if I'm talking about something that I'm not supposed to, as far as like legal things go. But my philosophy has essentially been investing is index funds primarily. I do a little bit of equity research when I have the time, and just because I enjoy it. And so I'll do a little bit, but for the most part, I stick to either small cap or S&P 500 index funds. And my philosophy is, and what I've been reading and the books that I've read, and reading Warren Buffett talking about it, and, you know, in his letter 10 years ago or whatever it was, where he bet against all the hedge funds and said, okay, if you outperform the index fund, I'll give you whatever, you know, right, or something. So my philosophy has always been that I believe in primarily that the stock market has grown about 10%, 8 to 10% per year on average, or the S&P 500 has for the last 70 years or so. And so investing in a low cost index fund allows you to match the performance of the market, whereas primarily, and sorry to talk, if you sell these products to somebody else, but primarily like hedge funds or mutual funds will be a higher fee product that usually underperforms the general market. Is that, what are your thoughts on that?
Yeah, that's very much what I wrote about in my book, and that's held true. Index funds, though, understand, yes, yeah, we're now talking about a quantitative approach to investing. Mm-hmm. And index funds were the first iteration of this quantitative approach. And what I tried to explain in my book, there are further refinements of it that do things that go about beating the market, that have been more successful than, mm-hmm, the pure form of an index fund. Mm-hmm. And those are called factor-based. And so there's a little bit more sophisticated approach than just a pure indexing. So, right, mm-hmm, but yes, those are all, what you're saying is very accurate. One of the things that they discovered when they first started index funds, and if you think about it, when you do an index fund, the trading is based on, they announce ahead of time what stocks they're going to trade, when they're going to trade them, and at what price they're going to trade, because they pick the market price. They just assume that, and they don't do any research. Yet they are as successful as you just described. So that really shows you what they're competing against and how they're not doing that well on the other side. And so they found a way to do that successfully. And that's part of the secret sauce. They have found a way to take a lot of the hidden costs out of investing that's really holding back. That's where Wall Street really makes its money. And yeah, that's why index funds are, and these other quantitative funds are as successful as they are.
And there is such a huge industry, and there's so much money made, I feel, on keeping people ignorant and right, making people feel that this stuff is too difficult. And it is basic, it feels to me like very basic math. And if more people were just given that initial foundation to start with, that investing is not rocket science, and you can be successful long-term, and you don't need to listen to the salesperson, you know, no offense to the salespeople listening to this, but you don't need to listen to a person who overcomplicates it, is what I think.
Well, I agree. To me, it's more of a magician's trick where they have you looking over here while what's really going on is somewhere else. Mm-hmm. And so that's what a lot of that is about the future and everything else, and how brilliant they are about the economy. That's not really where the action, they're helping you. They're getting you not to look where they really make their money.
Yes.
That's really what the story is.
Okay. So moving on a little bit. So you have recently launched a new enterprise here, Peninsula Family Office, with Steve Parker. Tell us a little bit about that.
Well, it's a variation on what I'm doing with Lifetime Capital, and it's really where we're trying to serve to help CPAs and attorneys and other professionals who have clients, and we're really filling in with other professionals to support them and making sure that holistically that all the needs are taken care of.
So meaning that I'm a high net worth individual and I have my CPA, I have my estate planning attorney, I have, even a realtor, and you are somebody who assists those folks to create a full holistic plan to make sure that everything is congruent, if that's the best
Right.
word.
So everything is integrated and coordinated. So everyone's working together. So not everyone has everybody on the team. So we'll fill in the holes, and we'll both fill in the holes and we'll make sure it's brought together in an integrated way. Because often you end up being the person who tries to coordinate all the different individuals. So we're trying to make it easier for you so that you don't have to do all the legwork yourself, because time seems to be the most limiting factor for most of us. So you can go on vacation, you can do things and know that things are taken care of for you.
That's great. That's great. So as I mentioned, you live in San Mateo with your wife, Ramona, and you have 4 adult children, 1 grandchild, soon to be 2. Congratulations.
Thank you.
And they're scattered all over the country, but they all grew up here.
Correct.
Great. That's great. And so you're also actively involved in the San Mateo Rotary. You just graduated from the San Mateo Leadership Program. You serve as the treasurer of the Peninsula Estate Planning Council, and you produce plays for your family.
Yeah, the family is a club up in the city, and we have
the family, the
Woodstock.
club. Okay.
Yeah.
Got it. That's great. That's a lot of stuff. So we met at a, if you remember, it was a mixer with, I think it was the San Mateo Chamber of Commerce or Burlingame Chamber of Commerce, maybe, in Union Bank, just below my office at the time.
Keller that's Williams, right. That's Burlingame. Right.
That's where we first met. And I remember looking at Fisher like, this guy does talk a lot and fast, but he seems nice.
I get quiet sometimes. You're right.
So, so you sent me a little document a week and a half ago with some of, your thoughts as to what's been happening recently and kind of where things are headed. Just go ahead. Floor is yours. Tell me a little bit about, what your thoughts are on the current situation and investing, the markets.
Okay. Well, in some ways, parallel to what we just talked about with the investment markets, you need to be real careful. Any real estate investor needs to be very careful about who they're doing business with and what to look for. So looking at your local market is the best thing to start with, because you're going to be local and you're going to get to see the first things rather than going into some other market that has already been picked over. I know when I was at RREEF, we made sure that we were enough of a player in any market. We had enough money going there that the brokers would think of us as one of the first buyers that they would take any deal to. If you're just there kind of coming in from out of state or whatever, you're not seeing the best deals first. I remember one time I was in Gerson Baker's office and he got a call from some guy in Denver, and he was not about to consider the deal because he knew the guy had called everyone and his brother first and everyone in Denver first before he picked up the phone and called Gerson. And he was absolutely right. And so you got to consider that as one of the first things. The second thing you need to really consider is what kind of control you have over a deal. Similar to what we talked about before about what kind of monies go out to everybody else in the game. In real estate, the amount of money that you make, the people I know who've been very successful in real estate is because they're very careful about how they spend the money. The money that goes out, so if you're paying agents, various agents, X% off the top and all that, there goes your return. The returns are when we go back to the returns out of the NCREIF index and everything else, we look at those are basically equivalent asset class returns to any other stock and bond kind of. There's no stellar kind of performance that are generally ascribed to real estate over time. Where people have made more money in real estate that goes with the idea of investing in real estate that have been so attractive compared to putting money in the stock and bond market. That has generally been because they have not incurred so much overhead that many that, like earlier Joe talked about, these mutual funds that have so many expenses to them. The big knock on those is because they have so much costs in them, and you can't get the really the market returns.
Well, that's the
Index
only thing they
funds,
underperform is the costs for the most
because
part.
the cost is what's really killed them, and hidden costs in particular, plus the overheads. If you own real estate directly and are managing it yourself, you can avoid that. And so that is the key. And that means you want to own it locally where it's close enough, you can do that. And those are the key things that I look at for you.
Let me ask you this. This might, so you don't have to answer this because this might constitute direct investment advice, but let's say most people, or let's say there's a number of people here in the area who have money. Okay, so let's say me, I have $500,000 that I'm ready to invest. The return's not that great here, Rick. If I bought something for, let's say I put 25, 30% down payment, let's say that is 33% down payment, 500,000, I bought something for 1.5 million. It would be a very low return. I probably wouldn't even cover my mortgage. I'm talking about just a regular residential property. So do you have, and so like me personally, I'm always thinking about, well, maybe I should go to up north, or maybe I should go to a Stockton type of area, or further south where the returns are a little bit better. And then I start thinking about, well, maybe I should research St. Louis and learn about those where it's like, you make the 1% rule. You can buy a house for $100,000 that rents out for $1,000 plus a month, and then you have crazy returns. But like you said, you get the worst deals. You don't know anybody if a fire happens, so touch a little bit about that.
Well, the problems I have, because Ramon and I have looked like in Florida markets and all that. First of all, you have to remember there's the whole balance of supply and demand. And when we've looked in Florida, I grew up in Florida, and my parents had moved downstate. We were looking maybe buying a place that was too far from them, and I just couldn't. Huh?
Where in Florida?
They were down in Palm Beach Gardens.
Okay.
And so, and it's gorgeous. If I had grown up down there, I probably would have moved back down there, because I grew up in Jacksonville and I wasn't going back to Jacksonville.
Little different.
Yeah, quite a difference. But the problem is next golf course inland, and there's no barrier. To me, the intercoastal waterway, you had to be between the ocean and intercoastal waterway to have something that had some sort of constraint. Out here, we have somewhat limited supply, and that gives you a control. So when you start looking at other markets, there are other dynamics at play, and there's a reason the pricing is where it is. I really am skittish. You'd really have to have a strong economic model of understanding the demographic movements and everything else before you really can understand why the pricing is where it is and how it might be evolving. You have to know really what the growth corridors are and all sorts of dynamics. It's not just a pure numbers game. There's a reason why the numbers are where they are and how they may play out. So you cannot just take it at face value that they're equivalent kind of returns and everything else. As Joe knows from some of the writing I've done, I'm not exactly excited about the way the current real estate valuations are. And let me just go through the formula, and then we can come back to where Joe is and how the advice would work. So if you look at the current returns, they're very low. So you're going in, and let's say you're getting a 3% return on your investment. So how is that based, and what are you going to expect? Because if over the long term you want to expect to get a higher return, in order to get a higher return than that means you're expecting the rents to grow faster than inflation, and so that's really the only way, or that some point in the future someone's going to accept an even lower return on their investment than you've gotten when you've gone. We call those cap rates, capitalization rates. So the amount of income you get based compared to the amount of money you pay. So it's the inverse of the price earnings multiple. And so if you look at that, that's how the equation works. It's really simple. And generally when you're looking on the institutional level, we used a 10-year hold on how we did that, and we do a present value on that. You can look on longer term, but it doesn't really change it much, how the numbers work. And so that's really what these are based on. And those are the two things: on how fast you grow your rents compared to inflation, and what your beginning cap rate is compared to the ending cap rate. And that ending cap rate really is a function of what the following buyer assumes is going to happen to the growth of rents in the future. So you're assuming then that future investor is going to assume similar growth of rents faster than inflation. And I just don't think those are reasonable assumptions. I have trouble believing that will
Well,
be
rents are already down in our area.
right
10,
now. They are
15%.
right.
Yeah.
Right, recently because of this recent events, and who knows what's going to happen with, because of now that have this virtual work environment, if that takes pressure off the local housing market, the rental market. And I talked to a friend who owns a bunch of properties up in the city who's going through that experience right now.
Mm-hmm. Yep.
And so you may want to keep your powder dry short term on that and let this play out. But anyway, so that's where that is. So, but that's how that underwriting works. You want to look at what your rents are compared to current market rates. So one of the things that we always look at is the rents that are currently in the property, how they compare to what the quote unquote current market rate is, to see if you have the opportunity when the rents roll over, there are opportunity to move them from where they are today to the current market. Because there's often you find there are opportunities for moving up, more upside, and those are generally in the prospectuses on the property, the listings, they'll show you those. And so that's one of the opportunities. And other opportunities to upgrade the property, because those are often listed. And you look at that. But as far as what markets you go into, I just generally think that if you're going into other markets, it's kind of like the guy at the poker game looking around the table to see who the sucker is. And it's always, if you're looking around, you're the sucker. So you just have to be very careful if you're going into another market.
I'm very direct and real and kind of transparent. So I don't like to beat around the bush too much. So for example, for me, I'm looking at areas that are maybe more prone for asset appreciation in a higher percentage in relationship to here. So for example, I personally like an area like Hayward, San Leandro, West Oakland, maybe north in different parts of Sonoma County, Napa County, that, I think can, based on your criteria, can kind of qualify for being my local market because I know these areas. I grew up here. I was born and raised in the Bay Area in San Francisco and the Peninsula. So, and I still am able to do some of the things that you're talking about, finding, deals, because I know here I'm kind of boots on the ground, the value adding. So finding something that needs work. All my contractors who I remodel homes for around here would go to all these areas, and I know how much things cost and I know what needs to be done. So that's like, personally, I'm just kind of throwing it out there. That's kind of where I'm at, or I've ended up. Right. Especially because I can't fly to places like, right. I used to own a home in Land O'Lakes, where the butter is from, in Florida. We bought it for $90,000, me and my partner, and sold it last year for $150 after owning it for 6 years, and rented it out. We made like $400 a month above mortgage. And I didn't do almost no research. And so I clearly was very lucky that the market went that direction. It was just pure luck, nothing else. But now you look at that, I wouldn't buy a property there for the 150, 160 with the returns that they have, especially with the risks associated going out of state. So I have kind of went full circle in a way of that. I am not necessarily focusing in my local San Mateo County market personally, just because I also can't afford it anyway, almost, right? But focusing on these outside areas that I feel are, they're priced lower than our areas, but geographically, West Oakland is a 15-minute BART ride from Financial District, San Francisco. So anyways, I said a lot there, but what are your thoughts?
Yeah, that to me is still close enough. It depends on who you are and what your comfort level is, and if you're willing to go roll up your sleeves and be in that market, and if you have enough connections that you can comfortably operate, effectively. I have some friends who are investing in those and doing what you described. They've been very successful doing that. So it's just a matter of who you are and your willingness to do it. The big thing for me is you need to be able to roll up your shirt sleeves and do it yourself instead of just outsourcing it to others. There's too much of a premium if you have everybody else doing it for you.
Correct. Yeah. And that eats your margins.
Right.
So tell me a little bit, like, obviously you don't strike me as the type of guy who makes bold predictions. However, give me the closest thing that you can to feed off what you just said about, it sounds like you're saying that the commercial real estate market, like multi-units, most likely larger apartment buildings, are at this point probably overvalued. Is that what you're saying?
I'm not going, as far as I'll go with that is, I've told my clients not to be invested in real estate at all right now.
Mm-hmm.
First of all, I would stay clear of, if we look at property types, retail, the shopping center type things is just a disaster zone. 40% vacancies or collections.
Sorry to interrupt, but that's why Candlestick was going to be a big retail movie theater thing. And now and years ago, they already changed it to condos, townhomes, office space, the old Candlestick.
Yeah, they're going to be multi-use. And so the right developer, in the right locations, those will ultimately be new kind of town centers type. That's going to be ultimately what they'll be. But generally what we've seen on those kind of developments, the person who makes money is like the third one in. You don't want to be the first one.
You lose all your money with the city for permits.
Yeah, well, so who knows? Office buildings we're seeing right now, who knows what the new space requirements are going to be. It's a real dicey thing. I've heard from some people the idea that they're going to be reconfigured to retail, to residential. That, I don't know about you, but that to me is a very expensive conversion. So you're going to have to wait and see on that one. Industrial, we'll have to see what that really plays out to be. So residential, I don't know what the shakeout's going to be. That to me, the demand's there. It depends on where you are in the country, on cost competitive nature of the environment, on where what that's going to be on the larger multi-unit. But then you're starting to talk about what vehicles you're going to go into, because do you have if you are wealthy enough, you're going to buy it yourself is one thing. If you're talking about going into an investment group that somebody else controls, that's a whole different deal. And those are things I'm not in favor of, because that means, especially if they're private, because once you put your money in, it's in. It's the tar baby. You're not getting it out.
You got to be an accredited investor and sign away that you know the risk that you're going to lose everything anyway.
Well, that's wonderful, but I just heard.
Well, no, that's what I'm saying. You could lose everything, and you sign that away.
I'm not keen on those. When I left RREEF, one of the things that I was big on, because we use a vehicle called a group trust. It was a different thing, but there really was not a secondary market. So if you're going to invest in a larger program, then you should have something with a robust secondary market, and those are REITs. So real estate investment trusts that are publicly traded is the vehicle you should be in. Period.
That's what you like secondarily after owning your own property, managing it yourself in your own local market. That's you would say number two.
You have protections about that. There's a robust secondary market. You have liquidity. And that's what you should be doing. But these other ones should not. If you need a 1031 exchange because you have a lot of tax, then you should go into another thing that you can do directly. But you want to avoid all these. I had a presentation recently about a Delaware statutory trust. Stay clear of those. All these other things where somebody gets control. It's just a way of losing everything. Be very careful.
Okay, that's very helpful. Now, forget this whole worldwide pandemic, COVID, and how that's going to affect everything. Just for a second, the way that everything is moving anyway, before all this happened, was away from retail and towards office space and more Amazon purchasing and more delivery and more direct to you. And then drones will one day be a thing and all of this. So I would think with that general trend of where society is going, that industrial might be something that we should be a little bit more bullish on generally. Depends on the valuation, of course.
Right. So I was agnostic on that per se. It was just a matter of valuation aspects of it. So once again, I was looking at, before the pandemic, I was advising my clients to pull out of real estate in general. So my comments really are pre-pandemic.
Okay. So generally you're saying get out. So
the valuations have been off because of the current cap rates to begin with.
What's really crazy right now, and you can see this a lot faster, like you said earlier, in the stock market, because that's, changes every minute, every second is a different price for stocks. So what we're seeing is an unprecedented increase in valuations. And in my opinion, I think it's kind of ridiculous that the economy stopped for a few months and everything, for example, I follow a company called Square. I don't know if you're familiar with them, payment processing. They're kind of a bank now.
Right.
And they dropped to 40 something a share. And I was buying, and I told all my friends buy. I said, this is a good price for this company. When it hit its max, and we're still in the heart of a pandemic, and all of these companies, small businesses, which is their primary customer, are out of business, are going to go potentially out of business and struggling. So all of their revenue is drying up. For them to now break a new record and be at like 130 a share is kind of nuts. So the point that I'm trying to make here is that what is causing this, my thinking generally, is investors' anticipation of inflation, and inflation specifically into asset prices, causing these valuations to make sense in the future. What do you think about that?
I think you're overthinking it.
That's my biggest problem.
You went places, I don't know. The way I look at it is when we get back into the investment markets, I believe that that's really a long-term investment, and you had a lot of short-term aspects to why you thought the valuation would be where it is, because of current sales and everything else. I think that realizing that we have a long horizon that's really behind what most of those valuations are based on. That's, my issue on the real estate was understanding how the underwriting of real estate itself works, which is different from my understanding about how the capital markets work on stocks and bonds. So that's why there's a little bit difference. For me, there's a dichotomy between the two. And so I really don't I just kind of accept as the efficient market theory about, stocks and bonds, but on real estate, I had just a different take on it.
Okay. So tell me a little bit more. You did write something, and now it's kind of blanking on me. One of the other, you spoke about REITs and about kind of staying away from some of these things like the triple nets and like the Delaware statutory trust and things where other people control. Now, what are you, but you're saying people should own their own real estate, but you're saying that right now you're not advising your clients to buy or be in real estate. Do you foresee something changing, or? Sorry.
So what I'm doing is I took them out of publicly traded REITs.
Okay.
So that's where because I'm not having my client, I'm not advising clients generally on direct investments as it is. If they do that, they're doing that. I will help them if they go that way, but none of my clients really are doing much in that area.
Mm-hmm.
So I'm not really making opinions on that. I'll work with someone if they want to go there and do that, because I have that background and can do that.
Yes.
And I can go and help with that. But that's not really what my article was about.
Got it. So what do you think would have to happen for in real estate and in the markets for you to change the position there?
I would want to see that the cap rates would come up substantially from where they've been.
Okay. So that means either rents increase or prices drop.
Well, rents increasing would be the opposite of rents would have to drop a lot. prices would have to also, prices really need to drop.
No, so I'm saying if you own a building and you have low rent and a high price, you have a low cap rate. So if prices were to stay the same and those what tenants are paying would increase, that would.
Oh yeah, your cap rate would drop. Right.
Yeah.
Yeah, but it also depends on where that is relative to market.
Correct. Yeah.
Because one of the things is you can't have those rents go up and be substantially above market and then claim. So it has to be a rent relative to market.
Yes. Well, it has to be realistic.
Right. Well, you can see deals sometimes be not market and then they claim it's a certain cap or whatever, and it's an artificial number.
I say that all the time. That's almost everything that's available already for sale on the internet. These larger projects, they already have unrealistic numbers.
Yeah.
Great. Rick, is there anything else that maybe I should have asked you that I didn't, or any other thoughts you had? Any closing thoughts?
No, I think this is a pretty complete conversation. You know, I'm here to help. You know, I love to help people, and you know, people have questions, follow up. I'm glad to talk to them about that, figure out, you know, what we can do to do things, and happy to collaborate with you on other issues.
What's the best way somebody can find you after watching this video?
So hopefully we'll have my contact information on here somewhere. Yes. And just please contact me.
Okay, perfect. We will have your contact information on there. And if anybody reaches out to me, I'll definitely highly recommend you. Rick, thanks so much. I appreciate it.
My pleasure.
Hope to run into one of these days soon when this all slows down.
Thank you.
Thanks.